Hello dear friends, welcome to another stock veil video. The topic of this video is Pfizer stock. As you know, as one of the world's largest pharmaceutical companies, Pfizer trades on the stock market under the ticker symbol PFE. The company operates in pharmaceuticals, biotechnology, vaccines, and cancer treatments. Especially with the COVID-19 vaccine it developed during the pandemic, it generated massive global revenue and strongly entered investors' radar. So, what does Pfizer do? Pfizer's main revenue streams are cancer drugs, vaccines, heart and diabetes medications, immune system treatments, rare disease drugs, and treatments for migraines and severe conditions. One of the company's strongest aspects is its massive R&D budget. It spends billions of dollars on research every year. Because of this, Pfizer is seen as a defensive stock. As you know, the healthcare sector doesn't completely stop during economic crises. So why was the COVID period so critical? One of the events that changed Pfizer's destiny was the COVID-19 vaccine developed with the German biotechnology company BioNTech. During this time, the company announced record revenues in its history. The stock surged. Dividend investors' interest increased, and hundreds of billions of dollars flowed into its coffers. However, when vaccine revenues started to drop post-pandemic, investors began to worry about growth, and that is why the stock has come under pressure in recent years. So why did Pfizer stock fall? There are a few reasons for its recent weak performance. One is the decline in COVID revenues. The extraordinary income during the pandemic was unsustainable, and sales of vaccines and antiviral drugs dropped significantly. Patent risk is another issue as the patents for some important drugs expire, generic drug makers step in, and profit margins drop. Regarding growth concerns, investors are now asking whether Pfizer can find a new major revenue engine. Despite this, it still stands strong. Why is that? Because Pfizer still has a massive cash reserve. It offers strong dividend payments. It has one of the world's largest pharmaceutical distribution networks and continues to grow through acquisitions. For example, in recent years, the company has aggressively targeted acquisitions in cancer treatment. Specifically, antibody-based therapies and oncology are becoming its main future growth points. Why do dividend investors love it? Pfizer is a company that has paid regular dividends for many years, continuing to attract their attention. Its status as a large, established company in a defensive sector, along with its regular cash flow and high dividend yield, leads many to see it as a long-term healthcare stock. Because of this, it gives its investors a lot of confidence. Are there any risks? Now let's look at Pfizer's analysis. As we mentioned at the start, as you can see here, Pfizer had a sharply rising chart during the pandemic, lasting until around December 2021. Since then, it has been drawing a consistently downward chart. Looking at the near term right now, it's sitting around $24–25. It's busy forming a horizontal channel movement between there and the $28.73 level above. In fact, as you can see, we had a trend here, but unfortunately, it broke downwards at the beginning of April. It looks like the pullbacks might continue. Of course, if the $25.18 level is broken downwards, the downward trend will continue. Let's see if a retest will happen here, or if we can cross 28.73 again. As you can see from the chart, a very strong battle was fought around the $27.35 level. We'll see together what happens to Pfizer in the coming days. However, the chart tells us that there is still selling pressure right now, and pullbacks might continue down to maybe 24.58. Wishing you all high profits.